Good afternoon, everyone. This is Jen Felton with GoldenCare, and we are pleased to team up with OneAmerica today. We have Keith Bercun, who can tell us about all the asset products and those recent changes that they've been making. And with that, I'm just going to turn it over to Keith, and let's get this started.
Jen, that's awesome. I love it. Short and sweet. Okay, very good. So let's go ahead and skip this over. So what we're going to do today is, yes, we definitely had some product changes recently. What I'm going to do today, though, is I'm not just going to go through the product changes. I'm going to go through our entire solution suite, and I'm going to show you how to make this a part of your distribution, how to add this into what you're already doing, whether you're an expert or a seasoned pro in linked benefits or have your products now, you've never sold these before, it doesn't matter. What you're going to love about today is I'm not just going to do a product dump on you. Number one, I'm going to explain to you why this is so important and something you need to be talking about. I'm going to talk about the industry itself. You need to understand why long-term care and linked benefits is something you got to be talking about to your clients, how to sell it, how to position it, which is two simple questions. And then I'm going to go into the concept itself, and I will go into the solutions and show you some great tools and resources, show you how to make money with this very easily by incorporating social media, ready-to-go content. I really think you're going to enjoy what you're going to see today. What I do want to tell you is this is an hour, and this is an hour that is packed with an enormous amount of information. So number one, if you like what you hear today, I do this training every Tuesday at 2 p.m. So yes, right when I finish this, I'm doing it again. It's a general training that you can join in at any time with an agenda, so you can join in at specific points and just hear certain parts over again. But more importantly is you're going to get excited when you hear these solutions. You're going to hear about lifetime benefits and guaranteed premiums and the ability to use qualified money and turning annuities that are taxable into tax-free LTC solutions. I mean, the products are incredible. I'm going to give you permission, though, right away to not worry about remembering how they work. All I want you to remember today is your opportunity. That's why you have a great partner and a great team in GoldenCare. Remember your opportunity so you can pick up the phone and say, hey, Jen, I got a guy. And they'll be able to walk you through the right solution with an illustration and talk you through that product choice again. But before we go into products at all or even how to sell it, let's talk a little bit about our company. You know, this is an important thing because there were 250 companies at one point selling long-term care insurance just 16 years ago. Now we're down to less than 10. It's a very hard product to be successful with based on claims experience and pricing. It's good to know a little about the company. One thing you should know, or several things you should know about us, is we're not new to the market. We've been doing this since 1988, over 30 years with these products. Our roots, our parent company goes back to 1877. We're A+ rated with AM Best, which is incredible. We've double A- with S&P, and we have a very high Comdex scores, one of the highest out of those in the linked benefits industry of 95. And we're a mutual company, which is great. We answer to our policyholders, not the stockholders. So why is this something that you need to be talking about? Why is LTC important? It feels like it's been shrinking. The only thing that's been shrinking is the industry. The problem is growing, and it's very expensive. If we're going back to Genworth's cost of care survey, and I've got the numbers from 2014, so these numbers have gone up 3.5% compounding every year. 1 year in a private room nursing home, just less than $90,000 per year. It's very expensive. And for clients that are thinking of self-insuring, maybe they're looking at that, well, it's only $90,000 a year. I could probably handle that. But let's just assume a pretty modest 3.5% inflation index, and that's pretty close to what the medical inflation actually is. It's around 3.6% right now. 10 years down the road, it's not going to be $87,000 and change. It's going to be almost $125,000. 20 years down the road, for your people who are 60, 65, it's going to be more like $175,000. So for those people that have, you know, very cavalierly, if that's a word, thrown out the objection, I'm going to self-insure. They're not really thinking of what this is going to cost in 20 years. And honestly, I'm just showing you the cost today with 3.5% compounding. It's not giving you the real story because there's 4 trends that are happening right now that are dramatically increasing the cost of care and the ability or the availability of care. And the first of those four trends is the baby boomers, which rounds out to nearly 80 million people, second largest segment of our population. And the first wave of baby boomers started hitting their 70s 2 years ago. 10,000 people a day are turning age 70. So put that into perspective. You've got the second largest segment of our population entering their 80s in the next 10 years, the prime years when they're going to need long-term care. It's nearly 80 million people. As it stands right now, there's already a huge disparity between supply and demand. What happens when the second largest segment of our population infiltrates that demand component? Watch how quickly supply starts to dry up and how it impacts pricing. And then we have medical technology. This is a great thing. The new CSO tables, life insurance tables for 2017 were launched. Everything looks good. We're living longer. That's great. Problem is, when you live longer, the chances that you're going to need care are so increased, you need to do something about it. Things that were killing us 30 years ago are now chronic conditions. A bigger life expectancy means a much bigger chance of needing long-term care. And then we have family dynamics. Pay close attention to this, by the way, because this is the number one reason people are buying long-term care. Probably won't surprise you to know that 75% of all long-term care starts in the home. But what will surprise you is to know that 70% of all home care is provided by family members. That's why people are buying this. They want to protect their family. Asset protection is important, but not as important as protecting their family. But even that dynamic is changing because you have mom and dad retiring to warmer climates like South Florida, California, Arizona, and what have you. Kids are staying put. So that dynamic is changing. And lastly, we have the government, which I'm clearly not going to make any commentary on this political administration, but what I will comment on is that over 40% of all long-term care is paid by the government. 42% of Medicaid spending goes towards long-term care. So whether it's this administration or the next or the following administration, there's going to be gross changes to the entitlement programs, Medicare and Medicaid, how to qualify, what will stipulate a claim on either of those programs because they are unsubstantiated. They cannot continue paying care at this clip. And I will say that this administration, in its first budget proposal, proposed massive slashing to both Medicare and Medicaid. And it's why the government continuously is introducing new legislation like the Pension Protection Act, partnership, what have you, to try to further privatize long-term care. And by the way, this $175,000, what it's going to cost 20 years down the road, that's just for 1 year of care. Average length of care for a man is 2.2 years. 20 years down the road, you're looking at almost $385,000 out-of-pocket cost for long-term care. For a female, this is why females are so much more to insure, average length of care is just over 3.5 years at 3.7. 20 years down the road, you're looking at out-of-pocket costs totaling almost $645,000. And people with Alzheimer's will live 8 to 20 years with the syndrome. For those people that don't think lifetime is absolutely necessary, talk to someone that has Alzheimer's, senility, Parkinson's, dementia. 8 years of LTC expenses, 20 years down the road, you're looking at almost $1.4 million. That's on one person. I call that the Titanic. Titanic, it was built strongest, biggest, most unsinkable ship ever built at its time, and it went down to the bottom of the Atlantic in less than 2 hours. You got clients going into their retirement, sitting on nearly $1.4 million. They're feeling pretty unsinkable. One of them gets something like Alzheimer's, and watch how fast their portfolio will sink down as well. But to me, the most disturbing number is the rate of occurrence, 70%. That's the chance over 65 you're going to need some form of long-term care. People aren't paying attention to that. Most people think they're in the 30%. By the way, nursing homes are filled with people that thought they would be in the 30%. So this information, great information. It's great to edify you as to why this is something you need to be talking about with your clients. The problem isn't going away. It hasn't shrunk. It's getting worse. But this data, these statistics and percentages, these costs are for you. It's not how you sell this. It's not how you position this. What we found, and this is one from a lot of research and from some pretty very widely heralded specialists in the industry, the best way to position this, the most effective, is by simply asking 2 questions. The first thing, look, Mr. and Mrs. Jones, I don't know if you'll ever need long-term care, but God forbid if you did, have you considered the impact it's going to have on your family, your spouse, your kids who have jobs and kids and homework and soccer practice? Because the very people you always swore your whole life that you would protect are the ones that you impact the most should you need long-term care. We need to talk about protecting your family. That single-handedly is what sells long-term care. And the second question drives it home. God forbid you needed this, how are you going to pay for it? Are you aware that nothing covers this except your own income, your own assets, which you've allocated for retirement, and also hopefully, of course, for some legacy planning? And this is how you make the transition into the linked benefit approach, which I love because it's really almost not selling anything. You're shifting money from their left pocket over to their right pocket. You're re-intentioning or repurposing an asset. And for that, you're just taking a small portion of their portfolio that they're not using for income to create cash value, death benefits, long-term care benefits, and with us and only us, a lifetime benefit of long-term care they can never outlive. Complete portfolio protection. So I'll get off the soapbox of how and why, but I think it's very important to cover that before I just go into our solutions. So let's talk about the products. I think you're really going to like what you're going to see here. Again, you're going to hear about lifetime benefits, premiums that can never increase, the ability to use qualified money, the ability to fund this literally from any source, annual premiums, 5-pay, 10-pay, 20-pay, single-pay, annuities, non-qual annuities, qualified annuities. It all comes in, and generally it all comes out tax-free, which is why this is such a unique opportunity. So the whole suite itself is called the Care Solutions Suite. And we have Asset Care, which is whole life, participating, combined with long-term care. And then we have Annuity Care, which is annuity combined with long-term care. And you have basically just all these different ways to fund it. With Asset Care, for your clients with a lot of wealth, you can fund it with a single premium. For clients that prefer to do more of the pay-as-you-go option, you can do annual premium payments, 5-pay, 10-pay, or 20-pay. And we have a fantastic, highly unique solution for clients that have their money in a qualified fund, 401k IRA or 403b. And then the annuity products are fantastic. Only one other company in the world does what we do, where we can take tax-deferred dollars and make them 100% tax-free, should they be used for long-term care. But regardless of the product you go with, the solution you go with, they pretty much all look, feel, and work the same in their base concept and design. And how that is a sum of money is going to come into the base of the product, an annual pay, a 10-pay, a lump sum from qualified money, or even if it's an annuity. Money comes into the base, and that money will have cash value. And if you die, that money will have a death benefit associated to it, or if it's an annuity, a benefit amount. So that money comes in. If you quit, you can get it back based on its cash value. If you die, it pays out to a beneficiary. And if you need it for long-term care, you'll use that death benefit amount or specified amount for long-term care purposes. And then you can always get what we call a COB, or continuation of benefit rider, that will extend your LTC benefits for a lifetime. Or you have a few different options, but most choose a lifetime benefit. So there's a base and a rider, and then the base is where any life insurance or cash value or equity is, and the rider is just strictly more long-term care benefits. And then the question is, where's your client's money? How do you want to fund this? Do you want to use a single premium, annual pay, 5-pay, 10-pay, 20-pay, annuities, or qualified money? And that's it. It's really, it's not, I'm not going to say it's simple, of course not, but it is in concept and design and how it works. But it's a huge opportunity. And looking at asset care, when you want to look at asset care, the participating whole life with long-term care linked, instead of the annuity care products, which is annuity combined with long-term care, is if you have clients that are between the ages of 50 and 70, they've got liquid assets that they're not using for income, they've got good income coming in from pensions, RMDs, and they don't want to buy a traditional LTC policy, they're more self-insured, that's when you're really looking at the asset care product. So let's show you how this works. Let's start off by talking about asset care, and let's talk about the single premium approach. I just want to make sure I have questions. My phone is cutting out quite a bit. Is my phone still cutting out, or is my phone good? I want to make sure everyone is hearing this. If the audio is good, would someone kindly raise their hand? You could put up a hand pretty easily. I just want to make sure you guys are getting good audio on this. Okay, good. Thank you. So this is the single premium approach, and again, really good for people who have built up assets and they're very affluent. So in this example, here's a client that says, I got $150,000 I want to put into this. Now, where we are so different is with us, you can apply as an individual or a couple, and you only have to do that on one contract. So it's a single premium because our policy is a joint life second to die chassis. That's huge because with any other carrier, if they have 150 grand they want to put into this, they'd have to do a contract on the husband for 75 grand and then a contract on the wife for 75 grand, which means they get a smaller death benefit. And of course, it's the size of the death benefit that determines how big your LTC monthly benefit is. So with us, a single premium or premiums come in and it only takes one premium to cover a couple because we're joint life second to die. So in this example, they said we got 150 grand. Of that 150, 95,000 is going to go into the base, creating a death benefit, as you can see in this example, of 186,000 and change, and the remaining 54,000 is going to go into the rider, buying a lifetime benefit of long-term care that can never be exhausted. So here's your base, and here's your rider. And the base is where your true equity is, meaning you put the money in. If you want this money, you can get it back. You look at what the cash surrender value is. If you die, you never need it. Well, this $95,000 is giving you a $186 death benefit. And if you need it for long-term care, you're going to use the death benefit, the $186, as your first pool of money for long-term care. You just have to decide when you buy the policy which option you would choose on how to spend down that $186 for long-term care purposes. And you have two options as a couple, either 2% or 3% of the death benefit, which works out to either 50 months or 33 months. It's the same thing. So in this example, we're showing a 3% acceleration rate or 33-month death acceleration rate. So if the death benefit is 186 and we're looking at 3% of that, that's about $5,500 and change per month per person to pay out for a long-term care benefit. So if they go and claim at the same time, they each get their own $5,586. So that's over $11,000 a month per person until they've exhausted the $186,000 death benefit. Now, if they do exhaust that, they're getting an unlimited rider, meaning this $11,000 per month will go on forever, even if they exhaust the death benefit because they bought this rider. And this is where we are so different. One premium coming in to cover two lives, a nice, pretty decent monthly benefit that can never, ever be exhausted. You can also get inflation protection on the base and the rider, or the rider only. And there's a few different ways you could do this. You could put the 150 all right here into the base, and there's 4 different ways to pay this rider. We're showing a single premium, but this can be paid with an annual premium, 5-pay, 10-pay, or 20-pay as well. Great solution for these clients with a lot of money coming in with a single premium. How do we stack up against the competition? Well, with OneAmerica, we're getting with that $150,000 coming in versus these other carriers, Security, Nationwide, Lincoln, and Pac Life. If they'd have to split that $75,000 each, the monthly benefit you're getting with us is significantly more, $5,586 per month per person, where with them, obviously, it's a bit less expensive. And mind you, with these other carriers, you're maxing out at 6 years. With us, it's a lifetime benefit. They can never exhaust. We look really well against the competition. But my favorite way to design this is instead of $150,000 coming in and funding both the base and the rider in one lump sum, let's take $100,000 and bring that into the base. Same thing, 61-year-old male and a 60-year-old couple, creating a death benefit of $194,000, a little better on the LTC monthly. It's a little closer to $5,900 per person, and we can pay a small annual premium on the rider, which I'm showing it broken up monthly. It'd be $325, $325 a month to get this extended out for a lifetime benefit. Because when you do an annual premium on the rider, you can break that up so it's monthly, quarterly, or keep it annually or semi-annually. So we're showing you for $325 a month, you're going to get $58.49 living on forever for long-term care. Incredible benefits, and the only carrier that will allow you to do it like that. Single premium on the base with an annual premium payment on the rider. This, by the way, can be paid by HSA dollars. And if your clients own a business, the business can pay for that rider, and it's a 100% deductible to the business. What's great about these solutions, the advantage is live, quit, or die, your clients are going to get value out of this. They want their money back, they take their money back on the cash surrender value basis. They live, they need it for long-term care. They're getting a lifetime benefit. They'll never outlive. They die, their money is making money with the tax-free death benefit. Our joint coverage, nobody has. It's a second-to-die policy, the only carrier in the industry where that money comes in and will cover 2 lives. Oh, and by the way, this $325 a month, these premiums are guaranteed. They're non-cancelable. They can never, ever go up, whether they're annual premiums, 10 pay, 20 pay, and whether you're paying it monthly, quarterly, it doesn't matter. Your premiums are locked in. They can never go up. Your death benefit can never change. And, of course, you can never spend down the policy to nothing because you have a lifetime benefit. Huge advantage that nobody else can talk about. Then we have our recurring premium options where you could do annual premium payments, 5 pay, 10 pay, 20 pay. In this example, we're going to show you just an annual premium payment, which we call pay to 95, because you pay until you're 95 years old. That's when the policy will mature. So in this example, here's a couple that says we've got about $6,000 a year. We want to put an annual premium, and that broke out to $58.22. So that's their annual premium coming in, of which $38.73 is going towards the base, and the remaining $19.48 is going towards the rider. Pretty small annual premium, less than $6,000 a year. They're each going to get $5,000 per month per person for long-term care. Actually, that's what we're solving for here. This client said, I want $5,000 a month. So if they go on claim, they get $10,000 a month, because if they go on claim together at the same time, it's $5,000 per person. So if they never need it, they still get a nice death benefit of $1.66 and change. And if they use this whole death benefit up for long-term care, remember, they're getting a lifetime benefit for less than $2,000 a year, still at $5,000 per person forever. So, compare this to a traditional LTC policy. Are we more expensive? Of course we are. But one thing you'll never see with traditional is a lifetime benefit. They don't have it anymore. Also, these premiums, base and rider, can never increase. Traditional, not only can they increase, they do increase. Not to mention with traditional LTC, there's no death benefit. You pay in premiums indefinitely until you start using it, until you exhaust it. But if you never use it for anything, there's no death benefit. And, of course, you have no cash value with traditional LTC premiums. So this is our answer to traditional LTC. And there's another carrier out there as well that provides linked benefits that has annual premiums, but we beat them as well quite handily with the lifetime benefit. Our premiums are a bit less expensive as well. And we've added something very new to the new solutions that we love, which is waiver of premium is built in now on everything. So you can get this policy, make one premium payment, and next year go on claim, and you will not owe any premiums on anything, base, rider, what have you. Even in this example, where we showed the single premium coming in the base and an annual premium on the rider, which they chose to pay monthly. Once you go on claim, anywhere, whether it's on the base or the rider, all premiums are waived. And as a matter of fact, the story gets even better. We make the premium payments for you. So if you're on a 10 pay and you paid $3 3 payments in over 3 years and go unclaimed for 6 years, those 6 years, even though you weren't paying premiums, they've been considered earned on the policy, and should you recover or pass away, there's only 1 premium payment left based on that. So how do we now talk about the use of qualified money? And this is where the products get really exciting. We've always had a solution, we called it Asset Care 3, that took qualified money. We've changed it now. We're just calling it Annuity Funding Whole Life. And the way this works is, similarly to Asset Care 3, we're still going to set up an IRA at OneAmerica. And in that IRA, we're still going to use a single premium fixed deferred annuity. The difference is, we used to use that annuity, we would give it an interest rate and drain it down over 20 years and use the money coming out of that annuity every year for 20 years to fund a 20-pay linked benefit life policy that would have a continuation of benefit rider with a lifetime benefit. We've changed it a bit, only entirely for the better. So the first thing is, number one, when you take your money out of the 401k or the IRA or the 403b, it's going to come out and it's going to immediately go into an IRA with us, into this annuity, and we're going to give it a 20% bonus right from the start. So if you're pulling $100,000 out of a 401k, rolling it into the IRA at OneAmerica in that annuity, that $100,000 will now be worth $120,000. That is a huge bonus and a huge added benefit to this new solution. We're also going to give it an interest rate of 1.1%. What we're then going to do is look at that total amount and divide it by 10 and pull out that number every year for 10 years to fund the 10-pay life-linked LTC policy. The money, of course, is coming out every year for 10 years from our IRA, so obviously it's going to be taxable. But what we've done is we've grabbed a lump sum out of their 401k to use as a complete funding method, and instead of paying tax on that big lump sum in 1 year, we're able to space that out over 10 years, add their spouse to it, give them a lifetime benefit, and fully protect them and their family from what this happens, should long-term care happen. This will satisfy, of course, required minimum distributions for anyone older 70 and a half, because we're pulling the money out of an IRA. So how does it work? Here's a guy that's got several $100,000 sitting in a 401k. We're going to pull out $150,000 of that and roll that into our IRA at OneAmerica, and we're going to use that single premium fixed deferred annuity. Well, remember, he's going to get a 20% bump out of the gate. That's another $30,000. So now that annuity sitting in the IRA is worth $180,000. We're going to divide that by 10, which is $18,000, and every year we're going to pull that $18,000 out and use that for a 10-year premium payment, 10-pay, on our life-linked LTC Asset Care. So year one, it's worth $180. At the end of year one, we pulled out the $18,000. Now it's worth $162. Next year, it's worth $144. And next year, $126. We continuously pull out $18,000 until it reduces all the way down to zero, and we've completely funded the policy. So how does this work? That $18,000 every year is going to come in, but year one immediately creates a full death benefit of $176,000 and change. So let's say they needed this day one. Well, the $18,000 came out of the annuity. The death benefit is $176 if they need it for that, but if they need it for long-term care, they'll divide it by the 33 months or 3%. It's going to give them just under $5,300 per month per person. Where this is so much different than the qualified solution we had before. The $18,000 that's coming in is paying the base and the rider collectively. It wasn't like that before. It would only pay the base, and you'd have to pay the rider out of pocket. That's one big difference. Another huge difference is if you go on claim while it's being funded over the 10-year period, all of the benefits are coming from the death benefit. With Asset Care 3 previously, we were using the exclusion ratio to determine that some of the money was actually going to come from the annuity sitting in the IRA, which made it taxable. This is now a 100% tax-free solution. All benefits come from the life policy. The third major new addition, other than that huge 20% bonus, is if the money is originating from the husband's 401k or IRA, we're pulling it from there to go into our IRA at OneAmerica. He no longer has to be insurable or actually be on the policy. That was a change. Previously, he had to be insurable enough to qualify to get our asset care product in 10 pay, or before it was a 20 pay. Now we can use his 401k money, take 100 grand out of that, or in this example it's 150, drop it into the IRA, into the annuity, pull that out over 10 years, fund the 10 pay, and if his wife is the only insurable one, she can be on it by herself. This is absolutely huge. We have changed this for the better in so many ways. This is now called annuity funding whole life. Again, taking 10 equal payments out of a sum of money that we just added 20% to, and using that payment every year to fund the base and rider of the policy. Absolutely huge, the change there. And the comp changed on that as well for the better for you as agents. The comp changed a lot of places for the better for you as agents. So I want to make a little shift and talk about the annuity products. And let me tell you something. If you're not selling annuities, it doesn't matter. The only thing you need to know is that your clients have them. And man, do they have them. There's over $2 trillion sitting out there right now in non-qualified annuity dollars. Last year alone, over $203 billion were sold in annuities. And the average purchaser age is 51 years old. This presents an enormous opportunity. Why? Well, the government got wind of this and said, wow, this is a big deal because a lot of people buy these annuities because they're tax deferred. The money comes in, it'll grow tax-free. So what happens with that is people have all this gain in these annuities, and they most of the time don't really need it, so they don't want to use it because they don't want to pay tax on it. Then they pass away with it, and it offers no taxable advantage to the beneficiaries of that annuity because all that gain is taxable upon death as much as it is taxable upon use. So how many people are really utilizing their annuity income riders? What you're going to find out is not a lot. About 83% of people, I'll show you in the next slide, are not using their annuities for income riders. They're great for growth. They're good for guaranteed life benefits. They're good for tax deferral. But the question is it doing what it should be? 83% of people buy these annuities. They don't use it for income. They do it because they hold on to them for emergency fund purposes. They don't want to be a burden on their children. So the government said, what an incredible opportunity to create some legislation that will be tax advantageous to further privatize the LTC market. And that is exactly what they did. January 1, 2010, as a part of the Pension Protection Act, they allowed the government for the creation of Pension Protection Act annuities. So what does that mean? Well, here's an existing annuity. This guy put in 50 grand. It gained $100,000. So now it's worth 150 grand. Typical annuity. This 100,000 is all taxable. If he uses it for anything, it's taxable. Dies, leaves it to a beneficiary, it's taxable. Because this, the way annuities works it's last in, first out. So he doesn't want to use it. But if he took this annuity worth 150 and did a 1035 exchange into a HIPAA qualified Pension Protection Act annuity, then all of the value of this annuity, including this once $100,000 taxable gain, is now 100% tax-free if he uses it for long-term care. Huge opportunity for your clients sitting on existing non-qualified annuities that they're not going to turn on for income. People between the ages of 70 and 85, they're going to be exposed to these gains if they ever use the annuity. And also this is good for people who might not qualify for asset care. The annuity products are a little easier to qualify for, but it's the same great value. You put your money in, you'll get cash value, long-term care benefits, and with us, a lifetime benefit of long-term care you'll never outlive. So we actually have 3 annuity care products: Annuity Care 1, Annuity Care 2, and our indexed annuity. Showing you Annuity Care 1, and again, I'm completely aware of how much information I'm throwing at you. I know it's borderline ridiculous at this point. But before I even finish this on the annuity care, The only thing I want you to walk away with today is remembering your opportunity. So let's just summarize that on the Asset Care products. For your clients with a lot of money, you now have a fantastic single premium approach where they can put their money in. They don't need it for anything. They get a death benefit. They can tuck their money back with cash value. And if they need it for long-term care, it's a lifetime benefit of long-term care they'll never outlive. And it only takes one premium to cover 2 lives. You got a great solution now for people with a lot of money for single premium. For clients that have more income prolific profiles, they're working or they've got good income coming in off their assets, you have a great annual pay option. If your clients that are executives, you get a great 10-pay option or 5-pay option or even a 20-pay option. Fantastic solutions now. And of course, for your clients sitting on a lot of qualified money, you now have a fantastic solution for that. Just remember that. The idea today is to get you excited to learn what's out there that you might not have known about. And you pick up the phone, you call Jen, you call whoever you're working with at GoldenCare and say, look, I got a guy. Guy's got a lot of money, no long-term care. What's the best solution? Just remember your opportunity. That's all you got to walk away with today. Looking at annuity care, how does this work? Very similarly to what I was just showing you with asset care. You're going to put money into the base. You can always get that money back based on cash surrender value. If you die and don't need it, you get that back as well. And if you need it for long-term care, you'll use the base first for that. Then you buy the rider. So how does this work with Annuity Care 1? You put a premium, a single premium into the base, and you can do a single premium into the rider as well, which is what we're showing in this example. You can also pay the rider off with an annual premium. So in this example, we're looking at an 81-year-old female who's sitting on an existing annuity that has value of $125,000. Had it for years, has a lot of built-up taxable gain, and it doesn't need it for income. Interest rate of about 3%, and she's just sitting on this, God forbid she ever needs long-term care. So she says, wow, what a great opportunity to look at this Annuity Care 1. So she says, I got $125,000. You know what? I don't want to put that $125,000 in the base and pay annual premiums for this lifetime benefit. I just want to pay off the whole thing all at once. 81 years old, fixed income. So she's got $125,000. She's going to pay off this whole thing. So $102,500 of the $125,000 pays the base. The remaining $22,500 pays the rider. So the way this works is there's 2 interest rates on the annuity care on the base. One interest rate that's providing cash value, but a higher interest rate that provides long-term care value, just like a regular annuity that has an interest rate for cash value and a higher interest rate for income accrual. Ours is the same way, but it's not income accrual. It's long-term care value accrual. But let's just say she needed this day one before it had any interest bearing on it at all. She put $102,500 in, and the only option to spend down this money for long-term care is 36 months. So she's got $102,500. So if she needed this day one, that would be divided by 36 months, which gives her $3,000 a month or $36,000 a year. So she puts $102,500 in. It's going to grow with interest every year, but if she needed it day one, her $125,000 that was sitting in an annuity before, that was mostly taxable, is now giving her, instead of just 3 or 4%, which it was throwing off, now it's throwing off $36,000 a year, 100% tax-free. She'll use that until she spends $102,500. But once she has, remember, she bought a lifetime rider. So that $36,000 a year will go on forever. So look at what we were able to do here. We took an annuity valued at only $125,000, mostly taxable, throwing off 3% a year, taxable. We turned that into $36,000 a year, tax-free for long-term care for the rest of her life. She dies, she never needs it. The $102,500 will grow and pay out to a beneficiary. She wants her money back. She gets the $102,500 minus 9 years of declining surrender charges. What would she have to do with this $125,000 to try to generate $36,000 a year? She'd try to have to find an annuity that's paying out at 29%. Good luck doing that. And again, this is all tax-free if used for long-term care. That's Annuity Care 1. A couple of years later, we came out with Annuity Care 2. We love this. We took Annuity Care 1 and we made it better. Why? Well, with Annuity Care 1, this is great, but she's coming from an existing annuity worth $125,000. To buy our annuity, she's losing $22,500 out of the gate. So now her new annuity value is 1025. I mean, who cares? We're giving her $36,000 a year, tax-free for long-term care forever with a lifetime benefit. Duh, obviously there's incredible value there. You're going to do it. But we said, how do we come up with a product where you can put a single premium into the base? And by the way, same thing here. She could do this with a couple can apply with this. Married couple, domestic partners, one premium will still cover 2 lives. But how do we come up with a product where the rider's included? They don't have to pay a single premium from the money coming in or annual premium, and that's how we came up with Annuity Care 2. So in this example, here's a female age 70 putting a single premium into the base, and the way this works is she's going to get 3 rider options to choose from, and one of them, whatever she chooses, is going to be included. So her options are an additional 36, 72, or 108 months of additional long-term care. She chooses one of these 3, and we're just going to include that. There's no annual premium, and there's no single premium to pay one of these 3 options. So how are we doing that? We're doing that because, remember, you're still getting interest rates on this for cash value and long-term care value. We're just going to take monthly charges off the interest you're getting on the base to pay for one of these 3 rider options, 36, 72, or 108 months of additional long-term care. Obviously, the bigger the rider option, the more the charges are, and the older the client is, the more the charges are, or obviously everyone would just select 108 months. And what I really want you to do is not think of this as 36 months, 72 months, or 108 months. What it really translates to is 2.5 times the base, 4 times the base, or 5.5 times the base. So simply put, to make this really simple, you're going to put money into the base of the product. It's going to go up with an interest rate. And if you chose the 72 months, that's 4 times the base. So the bottom line is, whatever your base value has grown to, we're going to multiply that by 4, and that's how much your total long-term care benefit is. So before this goes up at all, let's say she puts $100,000 in. Day 1, if she chose 72 months, multiplied by 4, that's $400,000 total long-term care benefits. So let's say you got a client right now sitting on $200,000 in a non-qualified annuity with a lot of gain, and they roll their money into this, and they chose the 72 months, which is 4 times. You can tell your client, sitting on an annuity worth $200,000, I can today make that worth $800,000, 100% tax-free if used for long-term care. Right now, it's only worth $200,000, and a good portion of that's taxable. Let me make it worth $800,000, give it 4 times its value. And by the way, that number is going to grow with interest over time, 4 times its value. Again, 100% tax-free. Incredible value on their money. And then our last annuity product is the index product. I'm going to spend like 1 minute on this because your poor brains must be absolutely swimming at the moment. And the way this works, and the only reason why we use this, is 90% of our applications we're going to approve. You only decline 10%. It might not be approved as applied for. You might be applying for like Annuity Care 2 with the built-in rider, or Annuity Care 1 with the lifetime benefit, or even Asset Care on a single premium with the lifetime benefit. We're going to go back and say, yeah, sorry, we're seeing some things here we don't like. We'll approve them, but you can only get the base of our annuity. This is where you go with the indexed annuity, because they're going to put their money in, and it's going to, of course, grow based on a crediting strategy associated with the performance of the S&P 500 index, obviously. What I love about this is it's still Pension Protection Act qualified, so they can bring money over from an existing annuity, and all that gains tax-free, and they can continue to get growth with us, and it's all tax-free for long-term care. That alone is huge. That's all you need. But let's say the S&P does well, your money's going to increase. But what I love about this, and you never have to explain the crediting strategy, the only thing you'll explain is this. Number one, like all indexed annuities, the guarantee is 0. So they can put their money here, park it here, it can never go down. It can only go up. If the market tanks, they never lose money. They still get everything tax-free, including the original gains. But the other thing that's great about this is if and when they need it for long-term care, they're going to get to choose between one of 2 very healthy step-up bonuses that will dramatically increase the base's value. So this is a great opportunity for people that might have insurability issues. They can get up to a 15% bonus on what the actual base's value is, or up to a 50% bonus on whatever the original premium is, and they would add that to the base. So huge bonuses there to increase the value for long-term care. We are a reimbursement payment model, not indemnity, and I get asked all the time, really what's the difference between the two and what should I really be concerned with? This is how I explain that, the difference between indemnity and reimbursement. With one of the models, you have to take the money in from the carrier, keep records and receipts for taxation purposes, make sure you don't go over the taxed per diem, pay out the vendors yourself, and you have to trigger the policy every few months. The other, just tell the carrier who your vendors are and pay them directly. That's reimbursement. You never have to worry about taxation. You never have to worry about paying the bills. We'll just pay them for you. It doesn't get easier than that. You never have to worry about taxation. From an underwriting standpoint, take a look here, but we will actually underwrite all of these conditions, even type 1 diabetes. We'll look, of course, at other health conditions associated with that, but we will look at chronic pain. We'll even look at people that are on narcotic pain medication, of course, depending on dosage and depending upon why. Cancer and remission after completion of treatment for 6 months. All of these things, believe it or not, we will still insure for. We do full underwriting. Most of the other carriers don't completely say that. We look for reasons to try to find to approve people. Now, if people are healthy and you're submitting an application, you don't have to submit any medical information on them. We'll get that information over the phone, and we will just run an MIB report and a prescription drug report and do a phone interview. If everything looks good there and they are truly healthy, we will not go after medical records, and we will not go after requesting a paramed. We do, of course, if there's something that comes up that we don't like, and we're doing that to try to find a reason to approve your clients. Underwriting is based on morbidity and mortality. We do rate if needed. That's great because, rather than just outright declining, your clients will rate them. And we have by far the most liberal height and weight chart. And look at, here's someone who's 5'6" can weigh up to 288 pounds. So we're pretty liberal with our height and weight chart. And before I let you go, I want to show you what the handouts are that I included. And again, if you couldn't download them, I'll show you. Well, you'll get an email from me that will have them in it. But I want to talk about social media. This is absolutely positively critical. Why? Everyone knows about it. I mean, it's a big buzzword, social media, right? But most people don't know how to use it, and certainly most people don't know how to monetize it. But why is this so important? Because pretty much everyone uses it. The majority of people look nearly every day. And whether you're an advisor, you're an agent, whatever it is you do, you always want to, as much as possible, have top-of-mind awareness with your clients. You never know when they're ready to buy something like this. And if you're consistently staying in front of them when they are ready to buy something like this, they're going to think of you. If you're an advisor, you should know 85% of people who bought a policy, a long-term care policy, had no idea their financial planner or existing insurance agent even sold long-term care. This, by the way, is using social media and doing it correctly and consistently is the easiest way to get referrals from existing clients and promote more business. So what's great about this and what's been so challenging is most people don't know how to do it. They don't have the content, and it's not made easy. I have a weekly social media subscription program, which of course is free. And what I love about this, it takes you 10 seconds a week to implement this. And one of the things I learned a long time ago is extremely important to take away time every week to work on your business, not just in your business. And what's great about this is I will be spoon-feeding you social media content and not product-related posts, mostly product-agnostic posts that are going to help you drive the message home as to why long-term care planning, family planning, protection, income retirement protection is so important. So we have memes that look like this, articles that look like this, and videos that look like this. And we're able to, and I'm going to launch a poll in just a moment where you're able to vote yes or no if you want to be added to our social media subscription program, which basically means once a week, you're going to receive an email that looks like this. Thank you for subscribing to OneAmerica's social media weekly posting program. This week, your post is a meme. It gives you easy instructions right here on how to take this meme and post it to your social media platform. Right-click on the picture below, save it to your desktop, and then post it on your platform. And here's the meme and what it looks like. So you just right-click, boom, and you do it. I even go down here with more detailed instructions based on the personal platform that you might be using. It's really only Facebook, Twitter, or LinkedIn. You need to be on Facebook because your clients, people that are going to be buying this, the 60 plus are really on Facebook. I use LinkedIn business to business, but you want to be on Facebook. But again, it doesn't get easier than this. You get this once a week. You subscribe, which you can do right here, right now. And if you want to unsubscribe, you want to stop receiving the emails, it's pretty simple. You just tell me, and then you'll stop receiving them. For your clients, your call to action is start thinking about clients who fit the profile of the products that we talked about. Remember, couples or individuals, you can apply two people on one contract. Great for business owners, great for people who have existing life insurance policies with cash value, and great for people that have money in their 401k or IRAs and people with non-qualified annuities. So I want to briefly launch this poll, and then we're going to go ahead and I'll just show you a couple of the handouts that we got here. But our poll, we're going to launch that right now. I'm going to give you 10 seconds to vote on this. It shouldn't take you longer than that. Again, this is if you want to start receiving our social media posts. It's just that email that you get. And of course, you can always unsubscribe. Obviously, it's free. So we're going to keep this poll open for another 5 seconds. Should be easy for you to just click yes. 5, 4, 3, 2, and 1. And we're now going to close out that poll. Thank you for voting. So just briefly, what I included in here is our Fact Finder. This is an incredible tool for those of you who are a little newer to long-term care, or even for the seasoned vets. This is the information that you want to get from your clients that you'll then bring to your marketer at GoldenCare. And this is everything related to writing the perfect 100% custom fit solution with OneAmerica. And that's what's great about these products. They are 100% custom fit solutions. You want their financial information, income, assets, funds, qualified money, non-qualified annuities, how much is gained, and if they have a traditional policy. A Fact Finder is an incredible tool. I also included our preliminary underwriting form. For your clients who might be on the cusp of insurability, don't put an application in. Fill this form out. Take you 5 minutes. No signature required. We just want to know their meds and their conditions. We'll get back to you inside of 3 hours, letting you know if they're insurable or not. Here's the transition rules. Here are all the states that are now live on this new product that I just showed you. Right here. And these are very important to know because the other states, California, Jersey, Arizona, the Dakotas, are still selling the old product. Here is a cheat sheet on what's changed between the old product and the new product, and here is our new comp. The comp's fantastic, by the way. We changed that quite a bit. For annual premium payment options, if they're doing the annual pay, it used to be 80% of the base was what was comped, and the rider you only got 8% on. Now it's 90% of the base and the rider. That is absolutely huge. On a premium of 10 grand, you'll make $4,000 more in comp than you were before because we're giving you 90% of the rider, not 8%. And the trail is still 3% for 10 years. The 20 pay is paying 75% on the base and the rider. The 10 pay is 45% on the base and rider, and the 5 pay is 25% on the base and the rider. There's no change on the single premium. It's still 8%. If you're doing the annuity funding whole life, it's 65%. Remember how you put money in, 20% bump, you pull that out every year for 10 years. That payment every year for 10 years, you're going to get 65% of it on the first year. So the example we saw was an $18,000 payment. You'll get 65% of that. So we've increased comps massively. And how do we look at against the competition with our new pricing? Still pretty much beating them everywhere. $6,000 a month benefit with a lifetime benefit with us. Only Nationwide can do pay-as-you-go annual pay. In this example, as you can see, we are, I'm trying to move my go-to bar, we're still $1,500 less per year. On a single premium, we're less than everybody. OneAmerica, this is showing you still lifetime pay with inflation protection. We're still beating them with inflation protection. With single premium, we're winning quite handedly over our competition nationwide in MoneyGuard, and on 10 pay, we are winning as well. So the new pricing, we went up. Sure, we're still less expensive than our competing carriers. So I want to thank you so much for joining in. I do have another training I'm jumping on. I wanted to try to leave some time for questions. Can money come from a Roth IRA? The question is yes, it can. The funds that pay for the rider are also going into cash value. No, they're not. There's no cash value on the rider. There's no death benefit on the rider. How do we avoid a mech with a single premium? We won't allow it to form. In other words, if it's a single pay coming in and we think it's going to be a mech, we won't allow it to quote. So we are able to safeguard against that. So look for an email from me that will have these handouts in it and some other valuable resources. Feel free, of course, call your contacts at GoldenCare. Work with them. They're going to be great solution specialists to help you. Don't worry about remembering what I just told you. Don't worry about remembering how these products work. The only thing you need to remember is your opportunity. Yes, there's non-facility options. Our benefits pay just like any standard traditional policy. Home care, assisted living, adult daycare, facility care, all of that. Of course, non-facility is a very large portion of what we do. So I want to thank you guys so much for joining in. We look forward to having you on future trainings. I do this training every Tuesday at 2 p.m. If you want that invitation, call your representative at GoldenCare. They can forward that over to you. You can join in and see this again as you like. I want to thank you guys again so much for joining in. In the email that I'm going to send you, there'll be information on how to see a replay of this as well. So thanks so much, folks. Happy selling, and we certainly appreciate and look forward to your business.
Thank you so much, Keith. Really appreciate it. Again, anyone, give us a call here at GoldenCare. The number is 800-842-7799. Again, 800-842-7799. Otherwise, thank you so much for attending today.
Thank you, Jen.